All right, hey guys, William Saunders here, and we're going to go ahead and get into the Forex Market Infrastructure Mastery. Okay, so keep in mind this is going to be extremely powerful, and I have a couple bonuses for you guys at the end as well that we're going to look at. Okay, so for starters, guys, you need to understand who your Forex participants are. Okay, so coming out the gate and like really starting out, the Forex market is made up of your central banks, your pension funds and hedge funds, who are like your large speculators, okay? Your investment banks and your retail banks, also your business and corporations, who are kind of like your commercial investors, the government. Then we have the market makers who are actually your dealers. You have professional traders and also professional brokers who are typically working with raw capital or they're under some type of regulation. Okay. So then you have down to it your retail traders and retail brokers who are individuals like yourselves who are not licensed, who are not under any type of firm or anything like that, or they're just working for a like they're like a white label platform, okay? So they're piggybacking off of the professional brokers, okay? Now, I want you guys to keep in mind that when you're trading, okay, it's pretty much all of these guys versus you as a retail trader, okay? So anytime you lose money in a market, it's because these guys is taking it from you. Okay, so you guys got to understand something. If the market is made up, let's say roughly 88% of their funds, and they know kind of like the standard stuff that traders are doing, like your stochastics here and your double tops and triple tops and all that stuff, don't you think they would play around that and take advantage of that whole type of thing? Okay, so this is why when you follow the textbook standards and everything of that sort, why it's not really 100% guaranteed, and that's why it only works, let's say, during this period or during that period, or you have to have multiple confirmations in order to have something pan out and be profitable. Okay, so I'm going to give you more insight on how you guys can be profitable and to understand the Forex market infrastructure with this mastery. Okay, so let's get into market cycles. All right, so starting from a standard point of view, especially from Weinclaw, the Richard Weinclaw, his standard was the market would accumulate, okay, then mark up, distribution, and then mark down. Okay, so let me go ahead and pull up a image of that for you guys so that you can see here. All right, so this is what Richard was actually originally stated. All right. Now keep in mind, mine's is it's very similar, but it's much more thorough. And as I begin to understand my style of trading, I found other traders that came closer to my style of trading, or was had like some type of integration. Okay, so keep that in mind. So Richard is more like this: accumulation, markup, distribution, then markdown. So essentially, this is what the market is doing. Okay, that's clearly what the market is doing. All right. Now, the reason why it's being accumulated is because the market was oversold. The reason why the market is trending up is because the demand was greater than the supply. The reason why the market is overbought is because that's the distribution phase. All right. Then the supply becomes greater than the demand, and then that causes the market to come down. Okay, so you guys may not understand this exactly, but I'm kind of like installing the seeds, and then later on, as you progress through your trading, it's going to make a lot more sense. So don't mind if you don't understand everything that you're going to learn here right away. Just watch this module over and over again, and you guys will begin to learn more as you gain the experience from implementing it within a market. Okay, now the reason why it's oversold is because that's the extreme point of fear by the weak hand guys, so the small term traders. So and that's why it's oversold. And then it becomes the first sign of your smart hand guys for the accumulation to actually occur, and they grab that. So during the time that it's accumulated by your institutional trend traders, your small time guys decides that that's the opportunity to sell. Let's go short. And they also have inactive trades. Okay, and that's exactly what causes the market to actually rise up against them. All right. So then at the major point of excitement by the weekend guys, so your retail traders, this is the first sign that your institutional traders want to start the distribution phase again. Okay. So now your weekend guys think that there's value within the market and they decide to actually begin to buy. Okay. And then that's when the distribution process actually starts between this group here where they decide how they can distribute the market in the volume amongst each other to make the most money, and then they cause the market to go all the way down. Okay, so essentially what the market is actually doing is it's allowing you to, have money in open orders, but then it takes that money back from you, and then it builds up more money and capital in open orders, and then, it takes it from you and kind of like this whole thing. And this is the reason why more than 90% of retail traders are losing more than 90% of their balance within the first 90 days, okay? So let's get into your time frame cycles, all right? Now, understand this. These are very, very clear, and if you stick to them, you guys are going to have great success. And it's kind of like the cheat code to Forex and everything of that sort, okay? So time frame cycles. Your lower time frames will display earlier entries. It's also going to be the first signs of reversal, and it's usually the pullback to the real trend. So that's what lower time frames, okay? Higher time frames is actually the real trend. It's going to provide additional entries, okay? It's also going to reconfirm your trend direction and everything of that sort. And it will also gauge your full potential profit, okay? So keep that in mind, even though it's not on here, okay? Now, my time frames is broken up into these categories. So scalper, intraday, swing trading, and long term, okay? So understand this. What we have here is the base. So I'll start from swing trading. So my base chart would be my H1. Okay, so that is kind of like my home chart, my base chart. Now the time frames that I'm looking for a earlier entry in first signs of reversal is going to be the 15-minute and the 5-minute. Okay. Now, if I want to confirm, let's say my maximum potential and the actual trend, then I would look at the H4 and then the daily. Okay. Now understand this. In this bracket, this is kind of like the average that I've noticed with my trading schedules, and that goes based on entries and everything like that. So my average entry for swing trading would be roughly 2 to 5 days. Okay. And this is like 2 to 5 trading days where I actually take profit, and it can be upwards of 2 to 3 trading weeks. Okay, or well, not trading weeks, but actual weeks. So these is going to be trading days, and this is just normal weeks. Okay, so keep that in mind. All right, now when I swing trade, my average target profit is 1 to 300 pips. That's average. From me taking an entry within 2 to 5 days, I'm getting 1 to 300 pips. Now, this right here is the projected drawdown, which means the market against me on average is roughly 30 pips. Okay, so I expect it to be against me 30 pips. All right. Now, if it's against me, let's say 90 pips because I took an entry, it doesn't mean that I've selected the wrong direction. It could mean that I'm entering a manipulation fade, and more than likely, it's just kind of like overwicking or something like that. So I'm not going to worry too much. All right. So intraday trading, understand this. The base is 15-minute. Your lower time frames are going to be M1 and M5, and your higher time frame would be the 30-minute and the 1 hour. Okay. Now, in order to trade intraday trading, you need at least 2 hours in the market, meaning that you can monitor your trades at least 2 hours and no more than 7 hours. Okay. Per entry, you're looking to get minimum 20 pips, upwards of 50 plus pips. The expected or projected drawdown the market would be against you with intraday trading would be 15 pips, okay? And that's because you're working with that 15-minute time frame here. Now, in scalping, understand this. Base is going to be 5 minutes, okay? I would never scalp using a 1 minute. Don't ever think you can do that. 5 minutes is going to be your base, and that's going to give you kind of like a average profit that's a lot more better. Now, your lower time frames would be the 1 minute, or let's say a 512 tick order bar contract, which you can actually get from futures or something like Thinkorswim, where they have those different chartings and kind of like all that stuff. Even TradingView may also allow you guys to go really, really small up on that. But and then your higher time frames would be the 15-minute. Now, if you're going to scalp, once again, you need at least 15 minutes no more than 90 minutes, okay? Actually in a market. If it's past that, you're no longer scalping, even though you're using that chart. This is kind of like your average. Now, per take profit would be 10 to 30 pips on average for your scalping entries. The market should not be against you more than 10 pips because you're working with a 5-minute time frame, okay? And the same thing, long term, my base would be the 4 hour, my lower time frames would be the 1 hour and 15 minute, and my higher time frames would be the daily and a weekly. My average trade hold would be 2 to 3 weeks, okay? Um, Average when it's long term trading, and that profit is right around 4 to 800 pips, okay? Now, it can be upwards of 2 to 5 months, but that's just kind of like something where it's very, very rare, or that's like, abnormal. That's not the normal, okay? But long term, you can do it upwards of 2 to 5 months, especially if you're catching these trends and everything upon your daily and kind of like that whole deal. Now, the market shouldn't be against you more than on average 85 pips from your original entry. And keep in mind, it can go up to 3 times that amount and it's still perfectly fine, okay? Now, your session cycles. Understand the best way to view this is going to be on the 15-minute charting. So your 15-minute time frame, okay? So here, this is going to be Eastern Standard Time, so you guys have to convert it to your time zone or New York time. All right, so understand that. Now, this bracket here is going to be the start of that session until that session actually ends. Okay, so if you can see there, that's the start, that's the end, that's the start, that's the end, that's the start, that's the end. Okay, Sydney session typically like to build orders from 5 p.m. New York to 8 p.m. New York. Okay, so this means it's going to collect orders, accumulate, that's what it's doing, accumulate, or it's getting ready for, distribution. Okay, so understand that. Tokyo session temporarily likes to set a, let's just say a temporary low or high, and that happens from 9 p.m. New York to 2 a.m. New York time. Okay, so it's temporary. So if you're trading Asian session and you notice that anything that sets low or high, just understand it's temporary. And also you can use these as key time frames to really come in and take your primary entries, okay? So you don't have to stay and watch the full market and all that stuff. London session typically sets the real low or high, and that happens between 3:30 New York time in the morning till about 5:30, New York time in the morning, okay? So that's what it typically do, and that's pretty much on average across all of your major assets and everything like that. New York session. This typically likes to reverse the trend, and that means it will go up to the, let's say, the fill level, if you guys understand what fill levels, or the nearest continuation point, or nearest, let's say, support or resistance, whichever one you're familiar with, okay? And then if it will pretty much continue the trend, so you'll be able to get it set up, 8:45 in the morning between 11:15 in the morning, okay? Now, during the last 2 hours of every session, the market typically likes to trigger new orders or track, close or open trades, close trades, kick them out, wick. So a lot of funny stuff will happen during the last 2 hours of every session. Okay, so keep that in mind. And basically that means that it can go into accumulation again or distribution during the last 2 hours. Okay, so we got weekly cycle here. Now, weekly cycle, once again, that time frame would be the hourly, so H1, and you'll be able to see pretty much the same setup, is just on a much larger scale. And this is really great for intraday trading, okay? Because, excuse me, this is really great for swing trading because that's your hourly and that would be your base, where this is really great for intraday trading, okay? So keep that in mind. You can use this to advance your trading and everything like that, which is going to help dramatically. So typically, okay, the market usually makes its final push before the reversal for the week. And this happens during Monday and Tuesday, okay? During Tuesday and Wednesday, the market will usually make its main high or low for the week. During Thursday, the market will provide another opportunity near that high or low by touching bases, okay? Meaning it's grabbing orders from the fill level or it's checking near that rate once again. Friday, the market will snatch back before the day is over, pretty much triggering orders, and Friday just basically looks like the best way I can explain it is Friday looks like Sydney, or no, let's see, New York session. Okay, so Friday looks like a New York session. So it's going to just zip back to where the high or low was, and then before it closes, it's going to end up looking like Sydney session. So that's typically how Fridays are. And you'll be able to just go back and look at Fridays and see how these behave and everything like that. Okay, now the market will open a weekend gap if Monday or Sunday is a holiday. You have like a 90% chance. So keep that in mind. Okay. And the EOMB is going to be the end of the month bridge. This tends to happen, okay, during the last Wednesday of the month to the first Wednesday of the month. Okay. So if I was to take a look at my calendar here, now we can see the last EOMB was the 29th until the 5th. The next one coming up is the 26th until the 3rd. Okay, so understand, during the EOMB, the market does not like to trend, like do any reversals. Okay, it likes to make trend continuations. Okay, so understand that. So if you notice that the market has been, let's say, trending up, and you reach your EOMB during this period here, it's going to stay trending up until after this phase, and it may not turn around until like let's say Monday and Tuesday of this week. Okay, so understand that, and that's because it's going to make the final push, and then you'll be able to take that reversal entry right here from that point, and then it's going to come back and, for the most part, clean back what it just set through here. So you guys just got to understand that. So between the 26th and the 3rd, it's not going to reverse trend. It's going to be doing fake reverse trends and everything, but it's really going to just go extend it and continue whatever trend is actually started. Okay, so monthly cycle, and once again, you guys are never like, no one really talks about, monthly cycle, and that's because a lot of people don't understand monthly cycles and all that stuff. People kind of get wind of weekly cycles, but monthly cycles they don't understand, and sometimes they kind of get wind of like session cycles and all that stuff. But so monthly cycle is pretty much very similar to weekly cycle. It's just a daily time frame. And December to January is when the market usually makes its final push before the trend change. Between March and April, the market will usually make its full reversal, or it will just do pullback to, let's say, that fill level or that rate again, and then break the continuation. Okay, during, between, let's say, April and July, the market will usually make its final push before making the reversal once more. Okay, and then around August and November, the market will provide another opportunity near the high or low of the year, and then it will lead into the end of the year bridge. Okay, which is basically the same, just like the end of the month bridge, except for this is from January to March of each new year. Okay, so keep that in mind. All right. Uh, all right. Okay. So analytical standpoint. So most of you guys, if you're coming into expert and you have, let's say, the elite expert or the private sessions that is actually done, you're going to hear me refer to as instant market data. Okay, so instant market data basically means that it's what the market is currently doing right now, right this moment. And that's all I really care about is that function. Okay, so this is instant market data. Now, historic or post market is kind of like past market data. So this is when you're scrolling back the charts and everything like that to take a look at support and resistance and everything of that sort. But you need to really scroll the chart, back and all that stuff. So some past history is needed in order for you to, take your current trades and all of that stuff. Okay, which I don't deal with past market data of that whole type of thing. To me, it doesn't matter if this is the new low of, 2001, or this is, let's say, the new high of, 2020 or something like that. You know what I mean? It past market data has no relevant to me and that sort. Only pay attention to instant market data. Okay. Now, forecast or projected market data is kind of like predicting future markets, okay? So this would be something like if you're using ABCD patterns, okay, 1, 2, 3, 4, 5 patterns. This would also be something like Fibonacci, okay? So you're predicting that. To be honest, moving averages and Bollinger Bands would be a way to predict the market and everything of that sort. Okay, so some things which is okay in regards to, let's say, harmonic patterns and all that stuff, I don't recommend that. I don't use those. And I have a specific reason of why I don't use those. And it's due to the application of it. Okay, so understand this. The market, and let me bring this back here so you guys can see. Okay, if this is the market, core structure, these 4 points, this is mean there's 4 possibilities that the market actually do. Okay, and that's just going based off of, this cycle. This is only 4 things the market is doing: accumulation, markup, distribution, markdown. Now, when you throw everything else on top of it, you're making it more complicated. Okay, so someone came in and they couldn't understand this and that, and they made it more complicated. So then they started with patterns. So then they're like, okay, triple top and double top. And when you get into price patterns, I'm telling you, you guys can get, let's say, easy 40 to 60 different patterns. Okay, when you get into Japanese candles, doji and Morningstar, inside bars, and all that stuff, another 40 to 50 pretty easy of different patterns and all this stuff that you're dealing with. When you get into harmonics, okay, you're talking about another probably 118 different harmonics and all this stuff that you're dealing with. Now understand this, okay? Not only are you making it more complicated, but you got to also keep in mind that all of those patterns fits into these 4 categories, okay? So the reason why all of those patterns don't work 100% is because they're not balanced within these 4 categories, okay? So that's why it doesn't work 100%. So what happens is, let's say the 2% or the 1% of the patterns that balance in these 4 categories the most, or whatever. So let's say a double top can balance within, these categories, let's say 80% of the time, right? But out of all the churn patterns and all that stuff, like a wedge and all that type of deal, or whatever the case may be, a double top may show up, let's say 40% of the time. So if you have something of this sort where only about 2% of the patterns happen majority of the time, 80% of the time, but you see the other 98%, let's say 98% of the time, okay, it's going to really mess you up. It's going to really throw you off. So what happens is the people that end up becoming successful with those patterns is that they know which patterns to stick to and how to trade just those patterns and to master those patterns and make money. But you still got to go through the whole hardship of bypassing all these other patterns that don't work and kind of figuring out which pattern that actually work, which one you actually can make money with. And by then, you've blown several accounts and everything of that sort. And it's just a much more complicated way. Okay. And to me, it is a way where people could come in and it's like they're destined to fail and they're destined to lose money in a market when you're following that stuff. Okay. So very, very simple. Down, like, it really comes down to these 4 patterns and everything like that, these 4 cycles and that whole ordeal. Okay, now mine's goes a little bit more, and we'll probably touch bases on that, coming down to there. And even if you guys don't understand laws of the market, you'll still kind of get an idea on how my system works and how the Sage Arts is and everything of that sort, which to me, and even my students' results, Sage Arts is more accurate than this 4 sequence that Richard have here. And it's way more profitable and all of that sort. But I like to start off with Richard because this is the basics of it. And this is kind of like the foundation that, a lot of people may be aware of, where mine is kind of like, it's the secret Sage Arts that people will never know about. You know what I mean? And it's just kind of like one of those things here. So now let's get into, let's see. Okay, so the Holy Grail Sage Arts. So this is what my system that I've just developed and discovered that I've taught some of my students that have taken X amounts and everything of that sort, and exactly what they're doing and stuff like that. All right, so guys, the Holy Grail Sage Arts, it's actually violation, law of the uptrends, violation, law of the downtrends. Okay, I mean, that's all what it really comes down to. So in fact, there's pretty much 3 things that we pay attention to, which is valuations and uptrend laws and downtrend laws. Okay, now your lower time frames and smaller valuations will be the first opportunities of exiting in a break even or take profit trade. Your higher time frames and larger valuations will be the last opportunity of exiting in a break-even or take profit trade. The more validations you have, then the better odds in your favor. So once you guys have learned the Holy Grail Sage Arts, then understand that validations is going to be the key, and that is what you guys are going to be focusing on. Okay, so this really goes in and makes it a lot more simpler and refined and everything like that compared to, the other cycle. Okay, so the fewer amount of things that you have to evolve in your trading, and that's more guaranteed. Like I can tell you, this right here is 100% guaranteed. 100% market valuations happen 100% of the time, and the market trends up, and there's a law to trending up, and the market trends down, and there's a law to trending down. Okay, so these three things happen 100% of the time. Okay, so understand, that is laws of the market and everything of that sort. Okay, so let me go ahead and show you guys how we basically select the asset pairs, okay, and the best way to go about it. So here we have asset groups. This is going to be from the easiest to pretty much the hardest, okay? So you guys can see AW is pretty much AU. So this is going to be the first easiest group that you guys should focus on when it comes to trading, because it's going to be easy to take profits, it's not going to be high volatility, and it's going to have the less manipulation. And it's going to have the least amount of manipulation, okay? The next group would be this set, all right? And then the next group after that would be this set, okay? Now, later on, once you guys begin to, let's say, identify your own groups, we have a specific formula that we actually use, okay? So anything pertaining to the JPY is going to be the easiest to trade. And then next, it would be Audi, NZD, Euro, USD, Swiss francs, CAD, then GBP, okay? So the easiest to trade out of this mix match would be, let's say, Audi, JPY, okay? That's going to be easier to trade than GBP, JPY, okay? Or let's say Audi USD is going to be easier to trade than Euro CAD, okay? Because you keep going deep in this bracket. So the hardest to trade out of every mixture would be GBP CAD and GBP Swiss francs, okay? Because as you move towards this right end, it begins harder and harder with this volatility within these currencies, okay? So the more you can stay closer towards this end, it's going to be easier to trade. So Euro JPY is easy to trade. NZD JPY is actually easier to trade than Euro JPY, and Audi JPY is actually the easiest to trade out of all the JPYs, okay? And the hardest probably would be GBP JPY would be the most volatile to actually trade. Now, we have other ways of selecting assets. So a margin cost to leverage versus the pip value, and you guys can click that link to get there. We'll talk about pip volatility, also market manipulation, and the market map. Okay, so let's go ahead and pull that up. All right, so when you're looking at margin costs here, and you guys can take a look, this is cashback Forex down to the margin calculator. Okay, you guys got to understand something. All right, so in this case, let's say you have a leverage of 500 to 1, and you're wanting to trade 4 lots. Okay, so if you take a look, leverage of 500 to 1 to trade 4 lots, GBP USD is going to cost a margin of $1,040. Okay, so $1,041, and you're making 40 bucks per pip. Okay, so let's take a look at this. If you have, let's say, a $2,000 account balance, that's going to be really close to a margin call and everything like that. So you won't have room to really work with. Okay, so it's going to be, let's say, $2,000 account balance. If the market goes against you, let's say 25 pips, you basically got margin stop. Okay, so that's no good. And on top of that, it's costing you $1,000 to hold. You got about 25 pips to work with, and you're making $40 per pip that the market is in your favor. Now, if you take a look at something like this, NZD USD, we can see it's half the cost and you're making the same amount, okay? Which means that you got 50 pips to actually work with the market actually going against you, and you're making the same amount because you have half the less, okay? So understand this. Let's say if you double this, and it would be the same risk. So if you went 8 lots on this asset, it would cost just about the same that you had here, and you would be making 80 pips, $80 per pip, okay? So twice as much for, pretty much the same risk that you would have initially had from here, okay? Now, that is one way that you can go about selecting your asset based on the margin to, the margin cost to the pip value and everything of that sort. But keep in mind also, if you're getting 100 pips, let's say within a week with GBP USD, you're not going to be able to probably get it within a week with this asset. So that's why it's okay for you to look into the volatility of things. Now, once we get into comparing the volatility, I like to go back and always take a look at 52 weeks, let's say 12 weeks, and then kind of like 4 weeks and everything like that. But if it's been a while, then I'll look at the last, 12 weeks and everything. But if you're consistent and kind of like really trading that asset and monitor, you don't have to go and the last 12 weeks and that whole type of deal. Okay, so let's take a look at Audi USD, and as we can see, it shows us the volatility in pips within per hour. Okay, so we can clearly see that on average it's still under 20 pips per hour and all that stuff. So put it this way, if you're looking to do, let's say, intraday trading and you want to hit, let's say, 50 pips, understand how long you would be sitting in the market per hour, which is kind of like the average. Same thing goes here. When you take a look at the average per day, we can see that the market really starts to pick up with this asset Thursday and Friday. Let's take a look. So we have it set on 50 here. Right here is about 60.2, which is kind of like that whole thing. And then even looking at the volatility here, is this like a much closer example of that sort? So, but I really don't use this too much. Now let's take a look at something else that is kind of like different. So GBP USD, as we can see, it's been averaging 100, and clearly right here doing certain sessions. So we got from 9, so this is more like London session to USA session. We hitting above 30 pips, averaging during that time 25 pips and everything like that. Okay, and for the week we can see that this has been getting on average like 100 pips and everything of that sort. Now, the reason why this is highlighted, because this is kind of like the current day. So this is currently Tuesday, and as you guys can see, that's why this is highlighted, and this is kind of like the current time for the market and that. So that's why it's actually yellow. Okay, so this is how you can just really come in and just scout. You may find a total different asset, and you just kind of want to know what it's been ranging and everything in regards to pip volatility and what you can actually get. Now, if you guys understand like the Holy Grail Sage Arts, then obviously there is no need for this. But unless you guys understand that and have mastered that, you have to go through these tools and resources. And plus, I want to teach you guys how to be able to, really know things about the market, from a analytical perspective. Now, when we're talking about market manipulation, we're talking about news from the week that's actually going. And let's take a look. So Tuesday to Wednesday, and I'll do it until the next probably Wednesday, and quote it down to here. So when I'm looking at market manipulation, I'm taking a look at red folders, and that's basically for the most part. Okay, so I see GBP has red folders here, and then also probably a good asset. We have USD, which is here. So GBP USD would probably be really good during USA session, where we can take a look here. We see we got CAD in the mix and also USD. So USD CAD will probably be really great here to actually trade. Now later on we have Audi. So Audi USD may be really great to look at during this day as well. Or Audi JPY during Tokyo session, Asian session would be really good. And let's say GBP Euro will probably be a tough trade to actually do, and even GBP CAD would be tough. So be very aware of that. There's going to be a lot of manipulation. So Euro USD may be good to trade during this time. And understand, since it's Thursday, I'm probably looking for the market to come back on swing trading near, let's say, the higher low near the week to give me another opportunity. Now, anything that starts doing this, so let's say you're going to probably follow the same news announcement that's balancing out during the following week. So we can see GBP USD for Tuesday, and also we can state USD CAD or NZD USD for Wednesday, or Audi USD. So let's take a look back at the following week and see if we have same movement. NZD USD, which we said, and GBP USD, which is here. Okay, that means that GBP USD and NZD USD, we have tentative for JPY, so Audi JPY may not be so bad, and USD JPY. So it's that whole thing, but definitely GBP USD would probably be something, based off of the news, that I would look into, because there's going to be some volume setting from this day, and then that volume is actually going to close and balance out during this day here once again, which means during this day you're probably going to get the high or low more than likely of the week with GBP USD due to this announcement that's actually going to come out. So that's a way to really pick out your assets and everything like that, okay? Now, when you're going based off of your market map, okay, this is with bar charts here, and this is the Forex Market Map, and this is really, really great and awesome to help you guys understand a lot of things, okay? So first off, we can see that all of these assets here in the green, that means that the market is actually trending up. Everything that's kind of like in the red, that means the market is actually, trending now. Now, if it's kind of like a heavy red, that means it's really, really trending down. So a strong trend down, and a heavy green means, it's really, really trending up, strong trend up. Where the faded means, it's kind of balancing out. Now, if you select any of this, okay, so if you can see here, here's all the cost references when you kind of highlight it like this. So if these are going up, then anything below is going down. So this is really great, so you guys can understand that, and you have a visual aspect. So if these assets is going up, then that's going down. Later on, when you're able to actually select the asset, then you can see the groups, okay? So from here, let's say if you're looking to trade this, then all of those that's highlighted in green should be going up, and all of those that's highlighted in red should be going down, okay? So you guys don't have to know it, and this is kind of like an easy way to take a look and say, well, if I'm looking to take a sell trade with Audi USD because I have a setup, it may be beneficial to look at NZD USD as well, and even Euro USD as well, because that ideally would be an easy mix to actually trade, okay? And then let's say it may be lucrative to buy Swiss francs USD, but that kind of depends upon your comfortability with that asset, because understand that that would be more volatile and hard to kind of work with compared to Audi USD. Okay, so that's something that I wanted to show you guys. So these are kind of like the 4 different ways that you can use, the software and tools and everything of that sort to gauge how to select an asset. Okay. And I want you guys to also keep in mind that you could still manually go by this grade here to select your assets, whether that depends upon the manipulation and the durability of it and how easy it is to trade. So I already have it grouped here for you guys so that you can work with, because it's going to be the easiest. Later on, when you get proficient in selecting your own asset, you kind of want to know, just based off of this, how tough it is. You can go with that bar. You can select that asset based off of the margin cost to the pip value. You can go based off of the volatility that you can actually get within a market. You can go based off of the market manipulation, and also off of the market map, as I just showed you. Okay, so in regards to the bonus, let me go ahead and show you guys that. Okay, so here's the bonus here. Okay, now understand this. Here is a probability based off of losing trades and winning ratio. Okay, so this is really, really great. This is the probability based off of losing trades and winning ratios. So how how often you would lose in a row. Okay, so if you take a look at this, if your winning rate, let's say, is a 70%, guaranteed, you would have a 100% chance that you would have 3 losses in a row. Okay, at any given point. All right. Now, as you can see, to have 7 losses in a row, you have a 5% chance, okay? 8 losses in a row, you have a 2% chance. And this is based off of the probability of 250 trades, okay? So understand that. So as you begin to, understand your winning rate, you can kind of see the probabilities of taking consecutive losses and dealing with consecutive losses, okay? And then there's ways of getting around this as well, like money management and risk to reward, which I'll show you guys risk to reward in regards to how to still, essentially have a low winning rate, but still essentially, pretty much profitably make money. Okay. But this is like a really cool way to identify and kind of know in advance how many trades you would be losing in a row. Okay. Now, risk to reward. Okay. This is a secret that I've known for a very, very long time. And this is something that I started to teach my students. Okay. So understand this. This is the percentages here. So if you have a 60% win rate and you're doing a 1-to-1, then you need to be 60% to be profitable. All right. If you have a 50%, you're breaking even. So this means if you're going for 20 pip, so that 20 pip is your take profit and 20 pip is also your stop loss, this is a 1-to-1. Okay. So that means if you're only 50% accurate with your entries, you're breaking even. If you're 60% accurate, you're making money. Okay, so that means you're profitable. So a 2-to-1. All right, so understand that. So this means that you're basically going, let's say, for the simple fact that you're dealing with a 40 pip stop loss and 20 pip take profit. Okay, so understand if you have a 40 pip stop loss and a 20 pip take profit, or let's say you have a 100 pip stop loss or a 50 pip take profit, okay, it just means that your value is kind of like 2-to-1 type of deal, okay? So understand that you would be profitable if you had a 100%, a 40% winning rate, okay, or a 50% winning rate, you would still be profitable, okay? Now, not profitable is 30%. Now, when you go all the way down, you can do a 4-to-1 risk to reward ratio, and 20% gets you break even, where 30% makes you profitable, 40% make you profitable, 50, like all that stuff. 5-to-1 has always been my favorite, including with, understand, when you run with a 5-to-1, that means like something you have a 250 pip stop loss and a 50 pip take profit. This has been my all-time favorite 5-to-1 to actually work with, okay? When you do that, your win rate is on average 78% to roughly, I want to say 88% on average by using a 5-to-1. And understand this, if your win rate was 20%, you're still profitable, and 30%, like everything is still, profitable. So your risk to reward is another way to have a low winning rate and to actually make money. Okay, so you guys just have to really understand that. All right, so once again, this is the Forex market infrastructure that you guys would be able to just immediately start to apply to your trading right away. And you guys also have your profitability so you can understand your winning rate a little bit more. And you guys also have a risk to reward so that you can identify that a little bit more and those concepts to where you need to have like a set amount to where you can be profitable and break even. Okay. So I wish you guys much success and of course, happy trading.